Right. The recording is started. So this is the second day of our investment readiness and uncertainty workshop. Today our focus is on the valuation of a business. So where we will start to look at the valuation, we need to look at the performance, then we look into different valuation techniques, forecasting and simulation techniques, etc. And after that, I will go through a case study to double look into the issues or the matters we discuss, and through the case study, we apply those techniques to show you how to actually manage this process or minimize the risk in this seeking finance process. Therefore, it might be quite challenging if you didn't do finance before. I understand quite a lot of you are the business owner and you are not necessarily the finance expert. So I won't ask you to do the numbers, to do the evaluation by yourself. In that process of accessing finance, you definitely need a professional accountant or team to help you evaluate the business. But the aim of the session is to give you an idea what can be done in this valuation process, so that you can use the techniques or ask the professional voters or the professional companies to provide that type of valuation to you. So that's the aim of this session. So that will be a lot of information. I know that could be quite overwhelming, but don't worry. I will share all the materials with you, including the evaluation techniques spreadsheet, so that you can look into them if you like, or when you need it in the future, you can refer back to find out what we have gone through in this workshop. Could you just please turn off your video? Just turn off the camera. That will save us some bandwidth. We can record the best quality. In the middle of your team session, if you move your mouse around, you will see a panel, a navigation panel. So that navigation panel, you see the first left hand is the camera. Click on the camera, you turn it on, you can turn it off. Okay, so at the end of this session, you will be able to evaluate the firm performance of business using different aspects of financial analysis. We'll look into different ratios, but that's not the core for this session. The core is to consider various techniques to value a business, and then understand different forecasting techniques to value the business and the uncertainty, particularly under this current situation. The EU exists, or the COVID-19 cases, this valuation is quite important. This is new. I think a lot of even the big corporations, they are coping with it, and they did learn some hard lesson in their investment if they did the valuation using the traditional way. Therefore, you do need to consider different techniques, methods to evaluate the business and the uncertainty. So we try to look into those, give you some idea, but each one of the evaluation techniques, it will involve a lot of numbering or coding, or actually the finance background as well. So just try your best to follow. I know it could be quite intensive, but if you have any questions, just raise your hand. I'm happy to stop and go into detail. So just let me know anytime if you have a question. So the workshop has been fully funded by the Best Girl Top as part of the Southeast Local Enterprise Partnership. If you have any about, say, support services or any feedback for the business support, please do contact the hub directly. I'm Dr. Ying Wang. I work at Anglia Ruskin University. I developed a workshop material, particularly in this session about the valuation techniques. I adopt some of the materials like case study from entrepreneurial finance, venture capital deal structure and valuation by Smith, J.K. and Smith R. 2019. So if you really were interested in this valuation, you could have a look at the detail of the book to see the techniques from different angles. But there are a lot of other materials available as well. So it depends on what you try to achieve, what you want to do with this valuation. So please do have send me email at yang.wang@aru.ac.uk if you have any question about the material. Before we start, I would like to remind you about the business life cycle. So there are two diagrams here. One is about the launch stage, and then the life cycle expansion, growth, shakeout, maturity, and decline. So you can tell from this diagram, the left one currently I'm looking at, you see the profit is the yellow dotted line, and then you got the dotted blue turquoise line, that's the cash flow. And on top of that, the black line is the sales, the revenue. The life cycle, it shows that at the beginning, even at the beginning of the growth stage, you still have maybe negative profit, a lot of cash outflow. So in other words, it's net a negative cash flow. You have more cash outflow than inflow. So that's at the beginning stage. And in the first session, we talk about if you are at this stage, you probably think about the source of finance to look into the yourself, your entrepreneur, your business owner yourself, your family, your friends, bootstrapping, and a little bit angel investor. Of course, some business do use crowdfunding platform nowadays to attract the funding, invest into their business. And when the business grow to the quite stable and link to the rapid growth stage, they might consider to shake out. So what shake out stage is, you have the product quite strong, you gain a massive market, it grow rapidly. Now you will consider whether I need a second product line in my business, or I provide another services from my business. So that's the second product business line in the consideration. And once it comes over this shakeout period that goes to maturity, you will notice that at this moment, you might have more cash inflow. You get a positive profit, but the profit starts to reduce. That's because maybe you have new competitor, maybe there are new entries to the business, maybe the consumer behavior change. Therefore, at this maturity stage, the business will consider what will happen if I actually walk into the decline stage. So that's the life cycle expansion. You will consider now the sale will reduce, cash and profit will reduce. Therefore, that is the decline. And later, if the company decides to exit this business line and go ahead with another one, that's where the company will consider to build a portfolio of what to do with this investment. So the business risk on the right hand of the diagram, you will notice here, you see the finance of this investment process. So what happened here is, if you think about at the beginning, it's very difficult to borrow from bank or from the other investment. What happened at that time is, if you consider as a startup or the launch a product, what you don't have is you don't have the credit. You don't have the established track about the operation of the business, and you don't have enough cash inflow, no profit. So that's pretty much like a pre-profit stage. Therefore, at that stage, debt funding is very low. It's pretty much like self-funded entrepreneur, family business, or bootstrapping, and more like angel investors. So that's where it's more equity finance. One of the reasons for that is business risk. When you enter into a business risk, you don't know what will happen really. You don't know whether it will be successful. You might have a big picture, a great idea, but the market really doesn't have the demand. So therefore, the business risk is quite high. Once you enter into the growth, rapid growth, and shake out of maturity, you have the established record, therefore business risk reduced. There has, for example, less liquidation problem or less bankruptcy risk, let's say, then the debt funding start to increase because at that time you can access more fund from bank. So, or from other resources, or maybe issue corporate bond, or maybe go to IPO. So that is when you will consider the funding of the business through business life cycle. There are a lot of cases that you need to consider the strategic planning. We mentioned about the business plan last session. We talked about if you want to get the right investor at the right time for your business, you need to consider your business strategy. And this is the same for a new business. And here is just a simple case for you to consider. For this case is where you will consider, for example, assume that you want to make a calorie-free ice cream. So that should be free ice cream. And you have the technology. So in the product markets, you must choose either a high margin, slow growth approach or a low margin, high growth approach. So those are the two ways to enter into a market. So with respect to the organizational design, you must choose either to enter only at the manufacturer level and then contract for distribution. Alternatively, you can enter into both manufacturing and distribution. So in other words, this is two levels. One, you focus on manufacture. Two, you need to consider manufacture and distribution. In other words, you might have your own shop to sell your branded ice cream in this regard. So suppose the non-integrated option involves selling through grocery store, and the integrated approach involves creating a network of branded ice cream store. Therefore, here you will have different strategies. So this planning, what is the best strategy? Which one works better with the business situation? Of course, it's case by case. It depends on the finance situation. So in this case, you want to start this new business. You don't have enough finance for that. And if you use the non-integrated, in other words, or focus on manufacturing, then you will consume less external finance. However, if you go into integrated approach, using both manufacturing, considering both manufacturing and ice cream store, then you need to seek for a large amount of external finance. So which option could be the best for you to start up the new business? A concept in this case I want to introduce you. Maybe you know that already. Maybe this is new, something that you come across recently. So that's what we say is the evaluation investment project appraisal. So in a project appraisal, we consider the net present value. So you see in the PowerPoint, it has an NPV. So NPV stands for net present value. So what it is, it actually tells you if you forecast future cash flow, that's the future generation for fixed years. For example, you consider 5 years investment and return. You discount the future cash flow back to today. So you find find out the present value for all future cash inflow, and then you take away your initial investment today. That will give you the net present value. So from this consideration, there's a matrix to consider. You consider organizational choice, one level entry or integrated. You consider product market choice, slow growth or rapid growth. So the choice about the market, it will affect the finance, because if you choose rapid growth, you will seek more outside financing. And of course, organizational level, if you run at a one level entry or integrated, the integrated level will cost more in that regard because you need to seek more outside financing. So in this matrix, we can tell that based on this case, the best consideration will be one level entry rapid growth, because it gives you the highest NPV is at $120,000. And if it is slow growth, one level is $40,000. If we look into integrated entry format, then you'll notice that if it's slow growth, integrated, it actually have a negative NPV. And in the accounting and finance decision-making process, if it's a negative NPV, you will reject this product. So that's the fundamental evaluation for a product. Appraisal, negative NPV, reject the product. Of course, you will consider there are other qualitative information you might want to take into account. But overall, if it is a negative, that means within this time period, you wouldn't get your investment return back in that regard. If it is an integrated rapid growth, it actually have an NPV $70,000. Therefore, that is another smaller amount than the one level entry rapid growth. So that's a product operation and the strategy level to consider an investment project, and a simple investment appraisal process behind this to help you make your decision. So the whole concept about this organizational level and product is to actually reinforce that we need to pay attention to our product. We need to pay attention to our organizational strategy and link finance with all of them. You see in this chart, the financial strategy, organizational strategy, and product market strategy, they actually have a knock-on effect. Each one of them will affect the other. So this triangle relationship applies to the finance relation applied to the financial, organizational, and the product market strategy. It depends on where the market is, what is your strategy that will affect the finance. In this regard, we consider what type of financing you will consider. Do you need to seek outside finance, or do you want to use more debt or maybe more equity? Or you want to consider some financial contracts like a loan covenants or maybe options or staging. So you borrow and you pay back in 2 stages. For example, some of the venture capitalists actually prefer this stage financing. So that's affect the financing of a business. And come to this point, we talk about your financial strategy. One of the key areas when you look into finance, you will examine or evaluate the financial performance of a business. You will look into revenue, net income, or cash flow. So you're probably not doing the account by yourself, but you will receive the report, the balance sheet, yearly report of your profit and loss account or cash flow account to know the financial health of your business. So in the financial performance management, we can consider different ways to evaluate a financial statement. So we can use horizontal analysis, or quite often you see that as trend analysis, or vertical analysis. The most popular one is actually financial ratio analysis. So the horizontal or trend analysis is you look into the account information. Maybe that will be useful to illustrate using a spreadsheet with you. Let me share a spreadsheet with you. So you see a spreadsheet in front of you. That is the SoftBank Group. You might hear the news that recently SoftBank decided to sell Arm Holdings headquartered in Cambridge to American technology company. After 4 years, they purchased Arm. So what happened with I would like to show you here is the SoftBank Group account. Of course, I download this from our university database, but their companies, public traded company information, you can find them from the stock exchange because it's public traded company. So here you will see a balance sheet account. So balance sheet, you will have, of course, there's asset, current asset, fixed asset, and then liability, current liability, non-current liability, and then you have the shareholder value. So the balance sheet will be balanced. That's the rule, golden rule about balance sheet. Therefore, what you have is the statement here is the total asset will be equals to your total liability plus your shareholder fund. So here you see these two numbers, they will be balanced. If not balanced, then an adjustment needs to be taken into account. So this is balance sheet. So if you want to do a horizontal analysis or trend analysis, let's say if you take 2015, let's focus on current asset for now, just an illustration. If you have a look at 2015 current asset, so 2016, what is the change? So you will find the change for these two numbers. If it is 2017, what is the change? Then you use 2017 compare with 2015, calculate the change. Similarly, you can do the 2020 and 2015. You can see the change of current asset with this horizontal analysis. So that goes to this way, horizontal. In other words, you find out the change of one item in your balance sheet. Instead of that, you can use another way to carry out analysis, which can be a vertical. Let me show you another spreadsheet so that you can consider the. So this is cash flow statement, and another statement that shows all the cash flow in a business. Another statement which is very important to all business is profit and loss. So the profit and loss, let me share a spreadsheet with you. Okay. Let me share here. So what we also have here is the profit and loss account. So the income statement is profit and loss account. So you can tell from the account that you have your revenue, total turnover, you have your total sales, And then cost of goods, so that's the direct cost of goods sold linked to the purchase the raw material, etc. And that will give you gross profit. Other than that, you will consider other operating items. After that, depreciation, amortization, and then you will have your operating profit and the loss. So this is gross. You will consider following this, that's the financial revenue, financial expenses. It depends on, for example, if you borrow from banks, you have the interest, etc. So that what goes to here. After take away those finance costs and revenue, consider them, you will have a profit before taxation. And after that is taxation, and that will give you the profit and the loss after tax. So this is what the company can use to decide whether they want to have a dividend, for example, whether they want to distribute those earnings with shareholders. Of course, for SoftBank, this account is up to 31st of March 2020 is a negative profit and loss after tax. And this is the whole parent company account for SoftBank. So that gave you some information about the profit and loss account. Back to vertical analysis, what you do is you consider the change of one, for example, if you consider the, let's say, the gross profit compared to your sales. So these two items, you can calculate your gross profit over total revenue, and that is in 2020. You can compare with the other years. So that goes this way, right? The change of that goes to the vertical way. So that's vertical analysis. Another important financial analysis, quite often you might not look into the direct number, but you can tell from the financial ratio of the business what is the performance of ratio analysis. Horizontal and vertical is very useful for the budgeting process, for the management accountant to look into the account to forecast. And key ratio is another area that will give you the idea about the profit. Can you see my spreadsheet? No, it stopped showing. Let me go back to the spreadsheet. There we go. So here, the key ratio, for example, return on equity, profit margin, it can have gross profit margin or net profit margin, return on total asset, current ratio, solvency ratio, that's the finance ratio, and PE ratio, that's the investment ratio. And you can compare and quickly see the change of the ratio. For example, in 2015, before 2015, you can tell that the return on equity is all over 30%. So that's quite good investment. And actually, that's one of the biggest company in Japan, so SoftBank. After 2016, you see gradually return on equity reduced quite a lot. So what happens is in 2016, SoftBank purchased Arm in the Cambridge in the UK, and then that has a lot of, the deal value is $31 billion, if I remember, or 24 billion pounds. So it's a lot of finance they need to manage, really, but they do have the SoftBank Vision Fund, which is 100 billion. So they need to manage the fund, and that's one of the biggest venture capital funds in the world, 100 billion. And gradually they invest in 2017, SoftBank invests in Uber, 18, 19 keep investing, and 2019, that's one of the disaster investments that SoftBank comment recently that is they invest in WeWork. If you know, WeWork is a real estate company that actually buy a building, reinvest it, and rent or lease the office. So that's the shared office, and that's a worse investment that leads to the negative return on equity from here. So that's the ratio analysis. Just give you some background about this. Not necessarily that you know every one of them, but if you are interested, definitely can do a little bit more research about them. So the ratio analysis, it got different categories. It's mainly, we can divide them into 5 categories: profitability, efficiency, liquidity, finance, and investment. So we mentioned return on equity, that's profitability, and this return on equity is very important ratio to look into. Efficiency, that measures how efficient the management of manage the whole operation, and that look into the stock turnover, for example, fixed asset turnover, sales per employee, etc. Liquidity is short-term ratio, financial ratio, to look into current ratio or asset test ratio. So what they look at is to see whether you have a short-term finance problem, whether your current asset can cover your current liability. That's the liquidity. Finance ratio is gearing or interest cover, so that's long-term. That looks to long-term debt and equity to find out ratio for gearing, for example. And investment, you got dividend per share or dividend payout, earning per share, P ratio. So those are the key categories of financial ratios. And again, for SMEs, you might have some of the ratio, but not all of them. But those ratios will give you a good information about the financial health of the business. Particularly here, even you don't have dividend payout, etc., you still can consider the other ratios in the business context. So the accountant will be able to produce those information for manager or the owner to consider. So return on equity is a very important ratio because this is quite often in finance field is called DuPont identity. So what it is, we turn this return on equity into 3 elements. So return on asset, we got the formula, and then return on equity, we got the formula. Now we merge this into one formula. So return on equity will give you idea about the net profit margin of the business, the asset turnover, and equity multiplier. So this will give you the idea about profitability, about efficiency, about finance. So that one ratio give you a good idea about the operation of the business. And some business, they might have a strategy, high volume, low margin strategy, or could be high asset turnover, but low margin strategy. It depends on there, but when you consider your business performance, you can compare with your competitor or relevant company in the same industry. So once you be able to get concise information about the financial performance of your business, if you come to a stage that you want to seek external finance, then that will come to the stage that you consider, how am I going to value my business? How much fund do I need? And the next stage is what we try to cover is where to, yesterday we did a little bit of that, is your investors, where you can find the right investors. So at this stage, I would like to ask some of you to share with us about your experience in the valuation of a business. Either you have seek finance before, or you are considering, so what valuation method you have used in the past? The valuation techniques, or actually how you value your business. Okay, I got some said on the chat that you didn't go through the valuation before. Anybody got some experience in the valuation? Okay. Okay. Thank you. Thank you for letting me know. Not a problem. So then we can move ahead and have a look at the valuation techniques. So perspective on the valuation of a new business. So first of all, you will consider, if I value my business, what techniques? What is the challenge? What could be the issues? Is there any solution to those issues? So in order to have a more accurate valuation of the business. So first of all, value of any business or investment product depends on its ability to generate future cash flow and the riskiness of those cash flows. So the riskiness of those cash flows in the valuation process, we use discount factor. The future cash flows, then that's the forecast, right? You focus your future cash flow. I will mention SoftBank's investment of WeWork. They invest totally about £10 billion. The deal, they purchased more than 80% of the share of WeWork, and they pay about more than £9 billion. Within 3 months, they lose about more than £6 billion. The value went off because the business consume a lot of cash flow. Of course, you buy those real estate, you make investment, refurnish, etc. If no one actually rent those shared office, then there's not enough cash inflow. And the business tried to go to IPO, initial public offering, in other words, publicly listed in the stock exchange, is failed because there are a lot of questions about the profitability of the business and the big issues with cash flows. Therefore, it's a failed IPO. After that, the value wiped off. Before IPO, they proposed the value of the business up to 47 billion. After IPO, it dropped to less than 3 billion. So that's the issue with the cash flow. And when SoftBank purchased WeWork, they used the discounted cash flow method, right? They focused the cash flow in a successful case, and the value of the business was quite a lot, multi-billion pounds. However, because of the failed IPO, because not good in terms of rent out the shared office, and particularly this year, because what happened with the COVID-19, the value of the business dropped down significantly, and that leads to the shareholder unhappiness about their investment, and part of that is the fund, they need to finance that as well. That leads to the business sell this arm again in this year. So there are a lot of issues about future cash flows, which we will cover shortly, to consider what we can do to value a business under uncertainty. The challenge in this valuation is future cash flows are volatile and it's difficult to forecast. The other factor is what is the proper discount rate. it can be tricky to estimate the actual discount rate, but of course we will have some proxy to evaluate that. People consider this fund from the new venture, for example, seek external finance, or when you do the new venture valuation, you need to consider the myth. I will go through the myth with you, of course. But the third myth I want to draw your attention first is investors demand very high rates of return. So of course here the return mainly related to equity investment, to think about if it is a seed stage or startup, the ROR could be 50 to 100, even more, and the total expected holding period could be more than 10 years. For example, angel investors, some of the venture capitalists, the return they seek in startup and seed investment is very high. As the business further grows, you see the return requires the rate of return reduced over years. If it is expansion stage, for example, if the business running stably, and now you consider to have new business lines, then with that credit, the rate of return the investors seek might be 20 to 30%. So this is normally for venture capitalists, for example, they seek for 25% at this stage. Of course, if it is a turnaround, what turnaround means if the business enter into a financial difficulty that has a significant cash flow problems, then in this stage, there are higher business risk again, because it have some financial difficulties. That's a higher risk. Therefore, the turnaround investment could be 50% plus. Of course, all the venture capitalists or the angel investors, they seek for unicorn. They try to get the value of the business. And this table actually gave you the return multiple on the invested capital for venture capital. That gave you some idea about what they look for, what project they tend to invest into. So if let's take venture capital will invest in business for 3 years. So that's 3 on top of the horizontal line. So that's exist years for investment. The vertical is the return multiple on invested capital. So if it's 3 years, and if they seek to get 3 times of the initial investment back when they exist the business, the annual return could be 44%. And you see here, they do have 3 years and 10 times that is 115% return. And maybe good to raise the point is, of course, they seek for the potential, and that's the trend for the future. Like SoftBank in 2000, the Alibaba in China had a very difficult running moment, and SoftBank invested $20 million into Alibaba in 2000. In 2014, Alibaba went IPO, and that year, that 20 million investment in 2000 turned into $60 billion. So that's a good investment from SoftBank, of course. But most of the investment, even including venture capital or the crowdfunding, the successful rate is not that high. So you need to pay attention to that. They could invest into a business but not make profit at all. But overall, it's a portfolio, so they can balance to get the profit for them, for the whole investment. So the myth about new venture valuation, the first myth, beauty is in the eye of the beholder. In other words, what it is, In other words, what it is, sorry, I saw the chat function is, Alan, you mentioned that you can't see on the screen. Can you see my PowerPoint slide? Can you see my PowerPoint slide? Anybody? Oh, yes. Okay, thank you. I might talk something outside the slide about the idea for that one. Okay. You mean SoftBank investment? No. Oh, yeah. Okay. Yeah, that SoftBank is this. I talk about what's going on today, and linked to evaluation of a investment linked to the business. No, it's not on the slide. It's just I talked over the ongoing corporate world finance issues. Okay, let's back to the myth. Beauty is in the eye of the beholder. So what that is you might hold a lot of belief of the company in your company, of the product, of the service you provide, but the investor might not see it. Therefore, in this investment, you seek external finance and you do the evaluation, it must match the right investor. So that's why you need to do more. You need to seek your investor, find out the right investor. Of course, it takes time. The future is in anybody's guess, and that's what we just mentioned about the cash flow. The cash flow is the forecast. I will show you in a sec that the different ways to forecast the cash flow, and that will give you some idea what you can do to minimize this uncertainty in the evaluation. Of course, the third one is they will require higher return. The fourth is the investor will determine the value of the venture. So in other words, most of the venture capitalists, they will propose a value of your business. However, if you know the valuation techniques, you will have a strong bargaining power in this evaluation, in this seeking finance process, because you know this is the value and the method you use or the evaluation you use there, we can't totally agree with that. So therefore, that will give you some negotiation power. The professional investors, they understand the trade-off between cash flow and the risk drives valuation. And therefore, you do have certain room to negotiate the value of the business. We'll look into that today and tomorrow to see the term sheet in this investment process. Of course, if the future cash flow we need to forecast, we have different ways to forecast. We can use scenario analysis, we can use simulation, we can use tree analysis, and that is a valuable way to evaluate the business. And the valuation is quite critical to the negotiation between the business owner and the investor. And to this end, you need to understand the deal structure, the term sheet, for example, with venture capital. Therefore, next session, we will look into the term sheet, the value, the deal structure in full picture, so that you know what that means to you if you come across this term sheet where you need to pay attention to. But certainly you understand it yourself, but you need professional solicitors or the lawyers to help you go through that as well. So the valuation, we can look into your assets, your revenue, and then forecast, analyze, and quite often you can find a multiple. That's a powerful word, multiple, and it really gives a lot of business use this as well in the evaluation. I will show you very soon. Then you calculate, you compare all the results you come up with the valuation of the business. Broadly speaking, in terms of valuation method, we have discounted cash flow, we have relative value, we have the venture capital method and the first Chicago method. Each one of them got their uniqueness, but they also have their drawbacks or weakness. So when you use these evaluation techniques, you need to know the drawback of that. If you have a professional accountant or another company consultant provide this valuation of your business, they will show you what method they use and what is the value. Then you will be able to tell what is the drawback of that. Does that truly reflect the value of my business? So discounted cash flow, we have risk-adjusted discounted rate approach, the certainty equivalent approach. Both methods use discounted cash flow, but they have different ways to evaluate. I'll show you in a sec. The relative value method is where the business will use a multiple of the business to find out the value of the business. Venture capital is another way. I will take you to them in more detail now. Discounted cash flow, if you use risk-adjusted discount rate, then you will focus future cash flow, and the future cash flow reflects riskiness of cash, the discount rate will reflect the riskiness of cash flow and time value of money. So that is where the discount rate will reflect of the risk of the cash flow and time value of money. The certainty equivalent method is where you will adjust for risk in cash flow and then discount it at a risk-free rate. So for new ventures, it's easier to implement the certainty equivalent method rather than the risk-adjusted discount rate. If you assume the same assumption, you should get the same result, but in reality, you will find different results really because the information asymmetry or not really the accurate focus in some of the cases. The relative method, relative value method refers as comparables or multiples valuation. So what it is, it uses market data on comparable companies or transactions. So they will consider the comparability include industry, business model, stage, size, and accounting ratio. Of course, the more factors you add into this matrix, the more accurate the multiple will be. So ventures with similar cash flows and risk, the assumption is they should have some value. It's widely used for established private companies. And of course, when the business try to exist, like IPO or mergers and acquisitions, they use this multiple quite a lot as a comparable to the other method. So the valuation multiples, quite often, it depends on what it is. It will find out the EBITDA of the company, and then depends on which industry sector. You see the sector reflect the business risk. EBITDA reflect the financial health of the company it is. Therefore, it comes back to this multiple. For example, if it is IT and digital, quite often you will get 6 to 12 times multiple. If it is healthcare, 6 to 12 times multiple. If it is food processing, 4 to 10 times of the EBITDA. But of course, this is only comparable way to help you consider the valuation technique. The venture capital method is quite popular in the private equity and venture capital arena. So they both combined the discounted cash flow and relevant value method. So what we have gone through both, they will consider them, combine them together. And one of the drawbacks for venture capital method is they consider they will have a successful exit. In other words, they make the investment, it will be success. It will be successful. And in reality, you know that this is not the case, right? So this is the main drawback for the venture capital method. However, to mitigate that risk in terms that successful investment, they use a very high discount rate to capture the time value of the investment, the risk and the bias of using success scenario cash flows, dilution from subsequent financing round. So those are the elements for venture capital method that they will use. Another method is first the Chicago method. So this is simplified discounted cash flow. That will help quite a lot because they use cash flow estimate for profitability. At this time, they use the weighted scenarios. In other words, they don't just consider success situation, they consider whether it will be fail or it will run as normal. So this is where they consider the scenario, build the scenario analysis into the evaluation techniques. And they tend to use more realistic discount rate. However, they do consider the possible outcomes and the other probabilities. So they will consider probabilities, they will consider scenarios. They have more valuation techniques in this process. So the case study I will go through with you will actually use all of them to consider the true valuation of the business. Option is another technique that you can use as well. So in the Black School's option pricing model, value increase with greater risk. I will show you a sample about this option. It's not a financial option. We talk about the option, apply option techniques using in the valuation process of a venture of a company, particularly to the private company. So there's a tree model, or game theory model that you can consider. I'll show you very soon on that. So when you consider the valuation method, you need to consider different criteria. If it is based on expected future cash flow, you need to know that possibly have some risk because it's forecast. Therefore, you need to use other techniques to make this cash flow forecast more stronger. And there is a cost of capital. If you use this as a discount rate or you use very high discount rate, that certainly will affect the value of the business or the investment project. And then you will consider that, for example, how difficult it is to estimate the information required for the valuation. Do you have accurate information? Do you have sufficient data available so that you can make the relevant valuation estimate more accurate? So this is the questions you need to consider in the valuation process. Therefore, in this perspective, there are a lot of address of financial forecasting. So financial forecasting is financial modeling, for example, to focus revenue, to focus income statement or balance sheet, and then can focus cash flow. So this is the forecast. If it is a new company, a startup, for example, it tends to use yardsticks. So what yardsticks is, if it is a new business, new venture, then they could use this to compare with another business in same industry, like we discussed, relative value method. So that's the revenue focusing. Fundamental is another way to do that, is actually it's more like a field experiment, field trip analysis. For example, if you want to open a restaurant, you might go to the restaurant and to see how many people visited and the possible consumption, and you might talk to the customer as well to get more idea about that consumption. So that's fundamental analysis to focus this revenue. When you focus uncertainty, we have different methods. One of them is, of course, you can use historical data to assess risk. For example, you can calculate the volatility, you can calculate the standard deviation of the distribution, and then use that as a focusing of future. You can also use sensitivity analysis. So sensitivity analysis quite often is more like a what if analysis. And the drawback of this what if analysis is you might be able to change one element in that focusing but keep the other constant. In other words, for example, if you change the unit price of the product, then you'll find out the cash flow change, the revenue change, and the balance sheet change. So the three accounts will link one to another, and that will reflect to the change of the investment. So that's sensitivity analysis. Another method is scenario analysis. So scenario analysis, for example, what it does is, rather than to think everything will happen 100% going this direction, you will consider, for example, what if the product fail? And then you might consider, okay, the product has 20% failure rate, and that's the probability. You might say 50% it will be successful, and then another 30% run as normal. So this is the scenario analysis. Another very popular focusing way to predict focusing on uncertainty is to use simulation. Simulation, it requires quite a lot to use this, if it is Excel macro or use other ways, then you need to consider it requires certain quantitative method techniques or econometrics in order to make the simulation focusing. Another way is to do machine learning. For example, I met another colleague in conference, and he worked in Siemens. What Siemens is doing is to use machine learning techniques. It's not simulation, it's not scenario or sensitivity, it's machine learning to focus the stock, to focus their the profit, the productivity, and focus the demand as well. So that's machine learning currently. So therefore, focusing uncertainty, it moves on to more advanced techniques. Simulation, about 70% of the Fortune 500 companies use simulation, and they do have the simulation tools. If you are interested, you can have a look at that as well. The option or the decision tree technique is another important techniques in this evaluation process. So what it does, it focuses on the most important choices, and they consider to construct the tree, what is known, what is unknown, and then they evaluate the choices. The decision will choose the highest expected NPV. A simple example is this accept or reject decision tree using option concept to open a restaurant, large, small, or do not enter, and then evaluate of course, behind this, there are a lot of numbers or evaluations, but I've shown you mainly the results here using this option evaluation techniques. So the decision will go with the highest NPV. So the highest NPV, you can tell here, the large restaurant got 191,500. Small is 176,000, and of course not under zero. So choose the largest that will go to the largest NPV. So the decision will go to run or open a large restaurant in this regard. Questions to ask before you seek external finance is how much money do you need? When do you need it? Is this need immediate, or you can shop around alternatives? And what is the fair value of the project? And shall you consider for which project you should consider for external financing? And what techniques you are going to use? How do investors select a project? And how you are going to settle the ownership? Because if it is equity investment, what is the terms or conditions for their investment? Of course, there are factors like whether it's the right timing for this project. If it is not the right time, no matter who you approach to, they might say, we can't do this investment. We are not interested in it, right? So there are a lot of information you need to consider in this valuation process. So what I would like you to do is have a quick look at the case study I sent to you yesterday. That is TA03, but the case study that I sent to you. Of course, I can do that with you together as well, but it might take a little bit longer time because I need to read them through. How about you have a look at the case study and let's see how fast you can do it. Then we will go through that together. If you don't have the case study with you, please send me an email. I will be able to forward the materials to you. So my email address, let me go back to my email address. There we go. This is my email address. Please send me email if you don't have the case study. If you do have it with you, please have a quick look. Let's start with 5 minutes or so. Then we hope to go through the case study together. If you don't have it with you, you can look my shared screen as well. So this is the case study that I shared with you yesterday. If you finish the case study or roughly you get the idea, then you can leave a message through the chat function. Then we will start to go through that together. 2 more minutes. You're probably near finished the case study now, and then we can go through that together. Yep, great. Shall we go through that together? Okay. A brief summary that you notice, like Paul mentioned in the chat function, that the venture capital look like want to reduce the value of the business. I have to say that the value of the business might be different in the eyes of the owner and the investors. Therefore, as owner of the business, you know what is the right thing for the business to do. For this particular case, you notice that the business itself the business, it is running a mail order business, specializing in electronic product, remote ability to adjust the lighting and the heating, etc. So it linked to technology, and now they want to develop an internet presence, and that's very helpful for the business to move on. What they want to do, they call it a mixed strategy, which is they running their existing business line at the same time they open a new business line on internet business. However, the venture capitalists want them to consider the business on internet alone and drop the mail order business. In other words, here you notice that there is a different opinion on the strategic vision of the business running in the future. And of course, Connected Home as the business owner, they want to have the mixed strategy. Therefore, they are not convinced by the venture capitalists that go to invest to move to the internet for all the business running and then stop the running of the business on the mail order. So that's the vision that you could consider that. Okay, if that's what the venture capitalists propose, is this the best for the business? But who is right? Could they both be right? Or could be one of them is right? As we are stand here, it's difficult to tell, isn't it? Because that does need to consider the situation of the whole business environment, of course, the strategy and the trend of the business, the demand and the supply. So it's difficult for us to debate that at the moment. But further down, that there's another issue in this case study is on due diligence, because the venture capital Black Oak partners, they are interested in this investment. Therefore, they want them to provide more information. They prepare a due diligence request list that includes to the Connected Home, but the management team at Connected Home has a lot of concern because they include a lot of confidential information. If that is what they want, if they want the investment, what they should do? They have concern, right? They have concern about the confidential information. So let's have a quick look at the due diligence requirement. So what they require, they want to know more about management and organization. So the organizational chart, corporate governance, management stock option program, composition of board and the board committees. They want to know the business history and the strategy. Of course, there are more items here. For example, the key suppliers, relationships with them, and then they want to know the competitive advantages, strength, and the weakness. So past analysis of the business. They want to know more about financial and accounting. So their financial, detailed financing history, audited financial statements since inception, and they want to interview their company auditor, all others. Those are the very sensitive information of the company. Legal information, bylaws and articles of incorporation, copies of all material contracts, leases, and agreements, review of outstanding resolution and potential resolution, interview with corporate legal counsel. So that's why Connected Home, they are quite concerned about their due diligence. So what do you think? Should they provide this information to Black Oak, the investor venture capitalist? If they provide those information, what they can do to protect themselves for this confidential information? An idea? Lily, if this is the case, what you can do to protect yourself in this due diligence process?
I think maybe the really critical information shouldn't be released, because you never guarantee that, that's my worry and concern.
Yeah.
But you also need to release enough information for the potential investors to feel confident to make the decision. So yeah, you have to really maybe get some expert advice on this, how to do it.
Yeah. Okay, thank you for that. Chris, what's your thought? Oh, I forgot Chris can't talk, isn't it?
Sorry, were you talking to me? It's Chris.
Yes.
Yeah. Yes, I mean, this is something that is always uppermost in my mind, is this question of confidentiality. That you know, in a situation like this, how do you know these guys know a lot of people in business?
Yes.
And I've heard it said that people have been done the dirty on, and that someone said, "Oh, this is a great idea, it's a fantastic idea," and have then given it to one of their mates. So it is something that concerns me, and I'm a bit dubious about you know, NDAs, just how much they're really worth if you're a small business and you're dealing with big businesses who can just tell you, "Well, go ahead, sue me then." You know, I think that's something that does concern me. I had a very interesting chat with some people this morning who were very, I told them as little as I could, but what I told them, they were very enthusiastic. But I did just get a little bit worried, you know. Yeah, so that's a concern that I would have.
Yeah, that's really the big concern for most of the business. And some of you, like Lily and Paul, propose that we need a written confirmation to set up this agreement that to remain confidential for the sensitive information of the business. And that's certainly one thing you can consider to put that into place. But this arrangement in reality could be very difficult to be agreed by the established investors. So that's something that you set up the agreement, but what is the is it enforceable? So this is where you do need to consider that you need to deal with investors that can be trusted, not to violate confidence or not to accept the risk that the information will leak. By any chance that you don't have that trust in the investor, and if you think that will put a lot of risk in that regard, is always the case that it's better to keep things more secure in either way you can. And this is more like driven by the case by case. I can't say all the investor will leak the information, use that to do something else. It's really case by case. But if you don't, you hold the, if you have that doubt, do seek more professional help in that regard. Lily? Yeah, you raise your hand.
Yeah, I think I agree with what you said. This is really case by case. And some, you know, we have also learned from running business from here with China for the last 15 years. So there's a lot of risks there. But doing business is all about taking right risks. So
yeah.
You have as a business, we need to need investment. Then we have to make the right decision to evaluate. First, I think it's important. We need to feel to feel that's the right investors, investors, not just because they've got money, but also we need to also do the background checking to see how different they are, and I think it's I know sometimes in this country maybe better you just do the written confirmation as Paul suggested, but not always safe when you run this in China, you know. So I still do think we have to take some risks, but we also need to manage the risks.
Yeah. That's really a good point to consider, how to protect yourself in this due diligence process and how you can make the best from this process. And back to the case, of course, there are terms of investing. There's a deal structure, the term sheet that provide a lot of detailed discussion on this as well. The call for today is about the valuation. The valuation, what happened in this process, and what is the concern of the business, why they don't trust their evaluation method. So I will take you through. So I will take you through the valuation techniques. So remember what we have gone through. We've gone through the discounted cash flow method, and that includes the two methods: is risk adjusted or the equivalent method. And then we have the relative value method. We have the venture capital method. We have the Chicago method. So the valuation technique I'm showing you through this case study apply those evaluation techniques. Let me share the spreadsheet with you. Don't worry, I will share this with you after today, so you can have a look. So this is where this spreadsheet, currently what you see is the revenue, income, and cash flow projection. So based on the year that they consider, they use this projected 5 years about the revenues, about the sales, about operating income, net income, and working capital, capital expenditure, etc. So they make some assumption of this, and then they project the cash flow. So this spreadsheet I'm currently sharing with you is the mixed strategy. So therefore, if you can actually click on the cell to see how the evaluation going on. So there's the 90% growth, and then the growth following each year, you see the change of that. So of course here, the percentage change is projected. In other words, those change based on the case is success. So this success case, what that means is you can have a look at the comments here to tell you more about the evaluation process in this spreadsheet. This is where we talk about venture capital evaluation method. Based on this case is success. So the project is free cash flow, and the venture capital investment will know that before year 3 they couldn't harvest any investment. In other words, you see the right color numbers here. So that's for example 2000, for example, is 6,899,000, and that's negative with a bracket negative. That is negative cash outflow. Up to 4th year, you will get less negative, and 5th year that will start to get positive. Therefore, this process tells you that before the 3rd or even the 4th year, they couldn't harvest the return from this investment. If the investment of this mixed strategy is intermediate, in other words, it's low growth of internet, the number changed here, so that you can tell from the percentage change of the revenue, right? So this stage, now we consider the different scenarios, and that is the Chicago valuation method. If low growth to internet, we, in other words, the mixed strategy where you will use the existing investment that is going on as normal, and the internet is less successful, slow growth, and therefore you see the change is less. Of course, that will affect the other changes here, and the number changed as well. If it is a failure of internet, again, this consider the Chicago valuation method, simple discounted with cash flow method, but consider different scenarios. So now it's 20% change of the revenue because it's total failure of internet, and now the number is here. So the 5th year will be negative in this case, and the 4th year, of course, more negative return compare with the success case. So that's the scenarios for the evaluation method. Now what happened is if they use continual value estimation, that will see after 5th year how much the value will be. So what they used 3 scenarios: success, intermediate, and failure. And here you will see that they have a multiplier. So this multiplier, they use the relative value method. They find the multiplier for the similar size, same industry, and different growth, same growth stage, or the other factor put together. They propose this multiplier. If it is a success, the multiplier of the 5th year there will be 3.5, and that's the value for continuous growth. If it is the intermediate, one is failure 1.25. It is intermediate, they choose the middle 2.5, and that's the value for the business. And they consider the outside financing for each one of them. At this stage, I would like to take you back to another spreadsheet about the valuation to give you more idea about the big picture. So that's about the success different scenario using Chicago method. So let me share this spreadsheet with you. This one. Oh, not this one. This one? Not this one? Sorry, I need to go back to look similar when I share. That's the issue. It's not the right one. This should be the right one. There we go. Yes. So this spreadsheet will give you a big picture about the evaluation. So based on the successful case, that is the free cash flow, right? I just show you that spreadsheet is, if it is successful with internet, if it is intermediate, it is failure. And there here, you see that is the success case. And this spreadsheet that gave you the idea about the valuation, the initial valuation. Connect to Home want to give Black Oak, the investor, 60% share. So what they propose, they need $7 million, and each share worth $1 when they seek this investment. Therefore, in total share purchased is 7 million. Consider the further investment. They have the second round is $2, and the additional investment required is 13,500,000. After consider second round, the ending shareholder for the venture capital is 14.36%. So the venture capital will consider 1 stage, 2 stage, and when they exist, what is their total shareholding, and that will reflect in the term sheet as well. So therefore, that include the term sheet, not just include what happened with this deal, that will set up the rules and the rise for the future as well. So now they do the revenue multiple, remember, is 3.5 for the mixed successful. Catalog is 1.25 if it is the mail business alone. If it is internet, is here. So they do the multiple and they use 50% discount rate. You can tell is extremely high, of course. If it is normal business running, it wouldn't be set up this high discount rate. But here you could say that that's the opportunity cost in venture capitalists try to seek here. So that's 50%. The present value of the cash flow is the sum of them discounted back. So that's present value formula there, which you can have a look using the after today. And then the continual value is where the 5th year continue using the multiple here. Then the enterprise present value is the sum of the cash flow for 5 years plus future cash flow after 5 years. No debt assumed within this time period. Then the equity value is here. By calculating all of them, 3 scenarios based on a successful case, then the Black Oak value, the investor value, is 9,671,000. Remember, they invest in $7 million. Therefore, the return for them, IRR, is where their minimum return here will be 11%. So if you know venture capitalists well, if you know you calculate 11% return for Black Oak, they will say no, because it's not attractive. What they look for, it is about 20 to 30%, right? Depends on the stage of the business. Therefore, here you will know this is not attractive, and that's indeed the case. They calculate this, Black Oak calculate this. They are not really interested in this performance. Therefore, they propose another deal. Another deal here, what they do is they still invest 7 million. This time, share price change. One share, it doesn't worth $1. Now it worth 60 pence. So after that, they consider second round similar investment $2, 13,500,000, and the ending shareholding for investor is 21.84%. So if you compare the first round with different share price, they will get 16.67% for the first round. Now they get 25%. The second round end up with 14.36%, with the new share price is 21.84%. The others remain the same, only the share price for the share venture capital purchase change, and now they calculate it. And all the other remain the same, other than the share price change, the share ownership change. Now you see the return to venture capitalists is 28% for the mixed strategy. In other words, this mixed strategy is what Connected Home proposed, right? They want to keep their mail order at the same time run their internet business. So there's 28%. That could keep them happy. So that is what the venture capital company calculated. Of course, they consider another angle, because the venture capitalist has expertise in internet, although they are not doing that now. They're probably still doing that, but they want to use this opportunity to further develop this internet in this presence through this business. They propose another evaluation. This time evaluation, they changed the change of revenue. Why? Because they think now they don't want the mixed strategy. They want to keep the internet alone. If they don't use mixed strategy, internet alone, the change of the revenue will change. So that's what happened. Income will change as well, because make a lot of investment, but they don't have any income, cash inflow from mail order anymore. So therefore you see the negative return here. They will make initial investment to keep the business running, pouring cash into the business and keep the internet going ahead. So what happened here in this scenario, if the internet business goes well, the mail order dropped, they realize that the fourth year, they start to get cash inflow. They start to harvest from their investment. For the other two, you notice that the fourth year still negative. They couldn't get any harvest from the investment, only the fifth year. For them, only the fifth year. Although the second one gave them 28%, they still think the harvest time is too long for them. They prefer to harvest in the fourth year. So 3 years investment, fourth year they get harvest. So what they do now is, if we do internet only, we simplify the running, and then the business with the investment, we don't need the second round investment. It will be simplified. 7 million investment by Black Oak. They don't need to seek external finance from this case. The share price still $1, and 7 million investment for the shareholding they invest. And what they consider is still the same 3-point multiplier. They calculate NPV and continual value. What they find out is, if it is a mixed strategy, it only 4%, no need to invest. Of course, it's negative, don't consider it at all. However, look at internet, they got 38% return. And that's where their 7 million investment by their harvest time, the value of their investment nearly doubled. It's 13,270,000. That is why the strategic vision that we had a little bit discussion on it is the Connected Home proposed mixed strategy. Now the venture capitalists prefer internet alone. So this is where it is best. So back to the investment. Let me share the other spreadsheet with you. This one. I will share with you another spreadsheet is for internet evaluation alone. So for this evaluation, you will notice that that is the big picture, why the venture capitalists prefer to internet running business alone without the mixed strategy. And that is from here. So everything is calculated here, of course, using different techniques, evaluation techniques. So that is the outside financing for the second round, and then discount, considering 3 scenarios. And then that is the dividend for them, how much they will get. For example, the total dividend in the projected is 2,305,000 if it is success case. And if the business go to IPO, how they change their shares into the public share, and that is calculated based on the common stock at time of harvest. And if it is success, and that's the value in project year, that's 2000. That's actually the 3rd year when they harvest. Therefore, they don't want to hold their harvest time longer. They prefer shorter, and that's why the strategy might be different in different ways. What others they consider is common equity. So this is the common equity, how much that worth, preferred dividend, and here is the VC interest. So venture capital interest, you see here how much they want, why they want this. Another rationale here, if you give them the 60.67% interest, they will get 9,338,000 based on their 7 million investment. So the net NPV actually for after they value the preferred dividend, so preferred share they will get preferred dividend is fixed paid every year, and that's one of the cases for the venture capital. You always create a new share with preferred dividend because they want to get their return every year, continuous dividend, and then get to the harvest. So the NPV is 4,387,000. It's less than 7 million, so you will know that they probably will reject this. For the 25% interest, that's the second case we look into, where they have the 7 million investment second round, but with the share price of 60 pence. Here the net present is greater than 7 million, so this could be the case. They will be able to accept. Of course, later on we have a look at the internet alone, and that generates higher NPV, and that's preferred by venture capitalists. But it's down to negotiation with the company owner and the investor, what is the best. Of course, it depends on. You also need to see who can get more bargaining power in this process. And that's the outside interest, and that's the founder's interest. I've shared this with you today, so you can have a look and use that if it is helpful. So what the business want to do is they want to do their own consideration. So they find out that the risk-free rate, of course, this risk-free rate is not the 3 or 6 months treasury bill normally we use in evaluation. For short-term investment, it's long-term investment, so that's 13.14%. Market rate is 35.66%. Market risk premium 22.52%. And that's the variance, standard deviation, correlation, etc. That is the cash flow generation. Of course, include more valuation technique, like I mentioned before. It could be quite overwhelming. It's quite challenging to cover everything within a short time as well. Another spreadsheet I will share with you is the internet valuation for the business by the venture capitalists. So what they do is they, let me find this spreadsheet. So for this spreadsheet, it's based on solely on the internet. In other words, they assume the business drop the mail orders business line, focus on internet, and that's the success failure of internet. In this valuation techniques, that's similar. You might see that similar spreadsheet before, and that's continuous evaluation outside founding dividend, pre-IPO, common share dividend, interest. So that's based on the internet only. So the certainty equivalent method, what they do, you see here, they now consider the probability. So when they consider probability, that means how likely it will be success, how likely it will be fail. And then they focus the cash flow, calculate expected cash flow. You see that is more like a portfolio method to consider success or probability and calculate them together to get the expected cash flow. And after that, they consider the present value, and that's where they base on this. If it is internet only, the present value for the venture capital you see here is present value of pre-harvest money common equity is more than is 71,789,000. You see the big difference, why they prefer internet only? If you have a look at it here, and that is pretty much the investment they make. The three highlights I make. You will know why they prefer internet. Of course, it generates more return to them. Compare with the mixed strategy that will better off. Of course, this is the value the venture capitalists see. If the business go to internet and drop the mail order, it will be better, the value will be better. But of course, the business owner running this successful mail order for a number of years, they would prefer mixed strategy so that they know this will be going on. It's difficult to say who is right or wrong, it's case by case, but you know that that is where the different opinion could come from, and that is actually from the valuation. It's not to the venture capital say this is the best, they come from this valuation. The other bit, you can argue that the valuation could be right, could be wrong. There are a lot of disadvantages as well. Just realized time passing by quickly. We are nearly there. If you have, okay, we can stop here. I will send you the materials. If you have a look at the materials, if you have any questions, please do ask me tomorrow before we start these 3 sessions. We can have a little bit further discussion tomorrow. What we will focus on tomorrow is to look into investor types and to help you prepare page, to help you prepare the information that you need for to attract investors at the same time, to complete the big picture of this venture capital or external fund or external source of finance. We will look into a term sheet. In other words, the contract you send with venture capitalists to help you make the full, get the full picture about how to negotiate with your investor when you seek external source of finance. Sorry, I might run a little bit late today. Is there any question you want or any comments you want to make before we finish here? No, there's no written task. I know you are very busy, but it just goes through that with you to help you get the good idea. So don't worry, I wouldn't ask you to do the evaluation. I wouldn't ask you to write a report or whatever. Don't worry. Just go through the case study to help you pay attention to the certain element in the term sheets in a case that you seek external finance. Any other questions?
No, thanks very much.
Thank you. I know it's quite a lot of information to take on, but like I say, as business owners, directors, you just need to understand them to know possibly if you ask professional to do things for you or in-house expertise to do that for you, you know there are possibly other ways can they consider that will do the work, hopefully. Okay, thank you very much. If you have any question, any comments, please send me email. I will share the materials with you for today.
Thank you.
Thank you. Bye.
Bye-bye.
Bye-bye.